This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of two videos on triangles. I'll begin by explaining what I mean by a triangle. My definition is broader than that used by many traders. I'll then talk about wedges, which is basically a triangle that's sloped somewhat up or somewhat down. And all triangles can lead to a reversal or a continuation. In other words, they can be a reversal pattern or a flag and a trend. I'm continuing my list of reversal patterns. This is about triangles, and as I've said with all the other videos, most reversal patterns require trading ranges. The market usually does not go from one trend into an opposite trend. It usually has to transition into a sideways market first. I use a broad definition for a triangle. Any sideways move with 3 pushes up or down is a triangle. If you have 3 pushes up, you have at least 2 pushes down. The minimum requirement then for a triangle is 5 legs. It's a sideways pattern. It can be contracting. The legs could be getting smaller. It can be ascending. The top could be flat and the bottom could be rising. It can be descending. The bottom can be relatively flat and the top can be falling. It can be expanding. The legs can be getting bigger. Any triangle that's sloped somewhat up or somewhat down instead of being sideways is a wedge. A triangle is a type of a tight trading range. It's a channel contained between 2 lines, and the 2 lines most often are converging. The legs are getting smaller. As soon as I see a tight trading range with at least 3 legs in one direction, I start to use the term triangle, but it doesn't really matter. I could simply call it a tight trading range. And in fact, if it doesn't look much like a triangle at all, I usually just call it a tight trading range. Here we have a bear trend, and then the market went sideways in a fairly tight range. 3 pushes down, 1, 2, 3, or 3. That's the minimum that I need to start using the term triangle. In this case, we also have 3 pushes up, 1, 2, and then 3. All I need is 3 pushes up or down. As soon as you have 3 one way, you always have at least 2 the other way. And then I can draw lines, and there are usually many ways to draw the lines. I can use this for 1, 2, and 3, and then you can say it had a bear breakout, and then an attempt at a bull breakout, both failed, and then a successful bear breakout. Here, 1, 2, 3, 3 reversals down. Here, 3 reversals up. Again, it doesn't matter if you call it a triangle or a tight trading range. Both are breakout mode setups. 50-50 chance you'll get a bear breakout, 50-50 chance you'll get a bull breakout, and 50-50 chance the first breakout will fail and the market will go in the opposite direction. In general, there's always a slightly greater probability that the trend that preceded the triangle will continue. If you have a triangle and a bear trend, even if it has 20 or 30 bars, there's always a slightly greater chance that the market will break to the downside. Once you start to get 20, 30, 40 bars, the probability gets very close to 50-50. And at some point, it's totally unclear and the probability is 50-50. A trading range, a tight range, is a magnet. The market is happy in this price. Both bulls and bears think the value is good. The bears think it's a good price to sell. The bulls think it's a good price to buy. And if the market gets outside of the range, the market often quickly gets back to the range. This is an area of agreement. It probed down here, and the traders decided, well, it's too low. Not enough bears want to sell here, so it has to go back up. And you can see it went sideways more at that price level. Finally, it broke to the upside. Anytime you have a triangle late in a trend, it usually is the final flag. Usually the breakout does not go very far, and the market reverses back into the trading range, the triangle, the apex of the triangle, and then it decides what to do next. Here we have a lower low major trend reversal, and then a higher low major trend reversal, and the bulls got a trend. Again, anytime the market goes sideways late in a trend, it usually is the final flag. And after the market breaks out, the market either remains in a trading range or you get a reversal. A triangle late in a bear trend, usually it's the final bear flag. Because it's a magnet, a breakout usually fails within about 5 bars, and the market gets pulled back into this area of agreement. Reversal down, another reversal down. Traders can draw a line, and you can see the line is descending. That warns traders of a possible contracting triangle. Initially, reversal up. Second reversal up, I would draw the line using this low. But then when we reversed up here, I would change the line here, and I would call it a contracting triangle. Again, it doesn't matter what you call it. All that matters is that you're in a tight trading range late in a trend. This is a magnet, and chances are it'll be the final bear flag before the market either enters a trading range or attempts to reverse. An ascending triangle is a horizontal trading range where the top is relatively flat, but there's a bull trend line along the bottom, a line that goes up a little bit. Reversal down, reversal down, reversal down, 3 pushes down, reversal up, reversal up, reversal up. Initially, I would draw the line using this, and it would be still a bull channel. And initially, I would draw the bottom line here and here. But once I see a third reversal, I usually ignore the second, even though it may sometimes extend below the line. And this is how I would do it. So we got a third reversal down here. I would use one here and then this to draw lines and view that as an outlier and this as an outlier as well. It doesn't matter how you draw the lines. It's a trading range that has at least 3 reversals up or 3 reversals down, and therefore I would call it a triangle. 50% chance you'll get a bull breakout, a 50% chance you'll get trend reversal. 50% the first breakout up or down will fail. In this case, we got a trend reversal, and it went down for 6 or 7 bars, and then sideways, and formed a higher low major trend reversal. Bear trend, bull breakout, A, B, C, pullback to a higher low major trend reversal. Again, initially I would use a line with this reversal and that reversal, and this reversal and that reversal. It doesn't matter how you draw it. It's still mostly a sideways pattern, fairly late in a rally. It's a breakout mode pattern. It lasted more than 20 bars, had at least 3 reversals down and 3 reversals up. My general rule is anytime you have a trading range that lasts 20 or more bars, there's a 50-50 chance that the breakout will be up or down. Remember, it would not be doing that if one side had an advantage. In general, I think the clear trend before the trading range has a slightly greater chance of resuming, but once you get 20, 30, 40 bars in a tight trading range, it doesn't really matter too much what the trend before it looks like. The market has a 50-50 chance of going up, 50-50 chance of going down. A descending triangle, the bottom of the channel is flat and the top of the channel has lower highs, a bear trend line. Reversal down, reversal down, reversal down here or here, so it's a triangle. I have 3 pushes down. That means there are always at least 2 pushes up. Again, I start using here and this to draw a line. It would be slightly descending, and then we tried to bounce here. I would change the line using this reversal attempt and this and ignore 0.4. Here we got a reversal down, a third reversal down. We're trying to get a bull breakout here. 50-50 chance the breakout will fail. It did. And then we tried going the other way, and the bears got a successful bear breakout. The market would not be going sideways for 20 or 30 bars if the bulls were clearly in control. They were in control here, but big up, big down, big confusion, usually sideways, and then breakout mode. 50-50 chance trend resumption up, 50-50 chance trend reversal down. My general rule, 20 or more bars in a trading range, the market is neutral. It can go either way. Reversal up, reversal up, reversal up, 3 pushes down, and therefore I start thinking about a triangle. If it's mostly horizontal like this, I call it a triangle. If it's tilted down, I call it a wedge. If it's tilted up, I call it a wedge. If it's tilted down, I would be looking for a wedge reversal. If it's tilted up, I would look at it as a wedge bear flag and look for a bear breakout. Anytime you have a horizontal pattern lasting 20 or more bars, breakout mode. Equal chance of a breakout up or down. Here we have a bull breakout. The bears tried to reverse. The reversal did not succeed. It became simply a pullback, and bulls bought above the high of this bar. It's a bull bar, a high one buy after the breakout, a breakout pullback buy, and we have 4 consecutive bull bars. The bears obviously exit as well. The biggest bear bar, 20 or more bars into a bear trend, probably an exhaustion bar. Probably will close the gap, get back above this low, above that low. And here we did. So now we have big down, big up, big confusion. You expect sideways and breakout mode. And we ended up getting the bull breakout. The bulls buy the breakout, they buy above the pullback, and the bears buy, they give up. And you get a give up bar right here. Triangles can be big, sometimes lasting 30, 40, 50 bars, but they can also be very small. Anytime I see consecutive inside bars, 2 or more inside bars, I know it's a triangle on a smaller time frame chart. Therefore, it's a triangle on this chart as well. You can see this bear bar is inside of that bar. The low is at or above the low of the prior bar. The high is at or below the high of the prior bar. And this bear bar is inside that bar. So now we have I. This bar is an inside bar, this bull bar, and it's followed by a bear inside bar, and that's followed by a third inside bar. That is a triangle on a smaller time frame chart. Every II or III is a triangle. It's a small triangle, but it's a triangle, and it's clearly a triangle on a smaller time frame chart. You can see the videos on candles, setups, and signal bars for more about III patterns. I'm going to now talk about a special type of a triangle. I call it a wedge. A wedge, like all triangles, is a trading range, and it has converging lines. If the pattern is mostly horizontal, I use the term triangle. If it's angled upward or downward, I use the term wedge. And sometimes you're not sure, it doesn't matter what you call it. You can call it a triangle or a wedge. In general, if I'm not sure, I call it a triangle. A reversal up, a third reversal up. To me, that is a wedge bottom in a bear trend. 60% chance or more, probably a 70% chance, you're going to get at least a minor bull breakout. Unlike a triangle, a horizontal pattern, you have a 50-50 chance of a downside breakout, 50-50 chance of an upside breakout. When the triangle is angled and I start calling it a wedge, there's a 75% chance that the breakout will be in the opposite direction. If I see a wedge that's going down, 75% chance I'll get a bull breakout, a reversal. The more it looks like a wedge, the more it behaves like a wedge. Here we have a wedge bear channel. 75% chance there'll be a bull breakout, and therefore bear channel, bull flag. It behaves like a bull flag. Odds are you'll get a bull breakout. There's often a bear breakout first. At least 50% of the time when you have some kind of a wedge, you'll get an attempt by the trend to continue. We have a reversal up, I draw a line. Here we're trying to get a bear breakout below a bear channel. 75% chance the bear breakout will fail, and we'll get to the top of the channel. And once it reverses up, I now have 3 pushes, 1, 2, 3. I know it doesn't have a good wedge shape. If I were to draw a line connecting point 1 and point 3, it would not have a very good shape at all. However, it's still a bear channel, 75% chance a bull breakout. 3 pushes down, I would call that a wedge, especially late in a trend. So I think the odds are we'll get a bull breakout and then either a trading range or a bull trend. Again, it doesn't really matter if you cannot tell if the pattern is a wedge or a triangle. Both are trading ranges and both are in breakout mode. The more horizontal it is, the more the probability is 50-50 chance breakout to the upside or downside. And the more it's angled, the more chance you'll get a breakout in the opposite direction. If it's a falling wedge, you'll get a bull breakout. If it's a rising wedge, you'll get a bear breakout. Reversal down, 3 pushes, and therefore it's a triangle. It's sloped up somewhat, so I would call it a wedge. It's in a bear trend, so it's a wedge bear flag. We got a bear breakout, but it failed, and we reversed up. Second entry, above this bar is the first one, and above this bar is the second. Still not high probability, but pretty good bull breakout. This makes me think we're going to go higher. We had a bear breakout attempt, and now we got a pretty good reversal up, and then we have another II, a small triangle, a triangle on a smaller time frame chart. The bulls see this as a pullback from this breakout. they'll buy on a stop above this buy, looking for a second leg up. A triangle or a wedge, both can be reversal patterns or continuation patterns. We have a bull trend and then a triangle. We tried to resume the bull trend here, but it failed. We have lower highs, so it's possibly an early bear trend. And in fact, this triangle became a reversal pattern. Where did the bear trend begin? It began up here. Even though we're still in a bull trend at this point, it turns out it was also in a bear trend as well. We're starting to get lower highs. Even though not lower lows yet, we're getting lower highs, so it's an early bear trend. It's a double bottom bull flag in a bull trend, so it's also a bull trend and clearly a trading range. Whenever the market's in a trading range, there's always a good reason to sell and a good reason to buy. 50-50 chance the bears will win, as they did here. 50-50 chance the bulls will win. We'll get a double bottom and trend resumption up. You can call this a triangle. You can call it a wedge bear flag. It's mostly horizontal. I would call it a triangle. Point 4 is slightly below point 2. If you want to call it a wedge bull flag, you can. You can call it 3 pushes down. 1 push here, 2 here, 3 there. Or you can simply call it a triangle. Again, it doesn't matter. The more horizontal it is, the more neutral it is. In any case, we got a successful bear breakout. Third push down, we have a lower high major trend reversal. You can call it a double top bear flag. You can call it a broad bear channel. Traders will sell a reversal down, especially after 3 pushes up. Bull, bear, and then bull, bear. So 3 pushes up. This is a wedge lower high and a decent sell signal bar here. They'll sell below it and they get filled right here. It's still a low probability short because you're shorting in the middle of a triangle. However, it's a reasonable short. The risk is small, maybe to above the high of this bar or the high of that bar. The potential reward is very big. A weak bear breakout, but look at it. We have 8 consecutive bear bars without a bull body. To me, this is always in short. It's a very tight channel. It's not quite a micro channel. This high went above that high, but it's very close to being a micro channel, and there are no bull bars. This is a breakout on a higher time frame chart, and I think after 3 or 4 of these bars, traders would conclude the market is always in short and an early bear trend. Higher probability selling here than there. At this point, we have 3 or 4 consecutive bear bars, 8 bars without a bull body. This is now probably a bear trend. Probably means it's more likely going down than up, so it's always in short. This is a higher probability short than shorting the reversal up here when the market is still neutral. Highest probability, 2 pushes up, 1 pullback, 2 below a bear bar, and then a bear breakout, big bar, big follow-through bar, both closing on their lows. This is where the final bulls are giving up. So this is a very high probability short for at least a little bit more down. I said a triangle has at least 3 pushes, 3 reversals. And here, reversed up, reversed up, reversed up, reversed up, reversed up. This is a horizontal pattern. The line on top is trending down. The line on the bottom is trending up. So it's converging. It's a triangle. And it's a triangle with 9 points in it. 9 reversals. Nothing has changed. Still 50-50 chance you'll get a bull breakout. 50-50 chance you'll get a bear breakout. Anytime you're in a trading range that lasts 20 or more bars, the market's in breakout mode. Whenever the market's in a trading range, in particular a triangle, the legs usually subdivide into 2 smaller legs. 1 pullback 2, 1 pullback 2, 1 pullback 2, 1 pullback 2. And then here, it's difficult to see. However, 2-legged moves are common within triangles, as they are within all trading ranges. Sometimes you get 3-legged moves as well. You could call this a wedge rally. First push and then a pullback. First push, reversal, and then a third push. Again, 2 legs up, 1 pullback 2, 1 pullback 2, 1 pullback 2, 1, and then this bull bar is a pullback, and then 2. As soon as I see 3 reversals up or down, it's a triangle. So at this point, I would call the trading range a triangle. We've had 3 reversals up, 1, 2, 3. That means there are 3 legs down, 1, 2, and 3. But sometimes, as I said, triangles continue on and have 7 legs or even 9 legs. Strong bear bars here, even stronger bear breakout here, and then again here, again here, again here. The bears keep trying to resume the bear trend. They keep trying to get a bear breakout and another leg down in this bear trend. But they keep failing, and each breakout attempt is weaker. This bear breakout is weaker than that, and this one is weaker than that. What's happening is the market is discovering that there are not enough traders willing to sell at this price. Therefore, the market probably has to go higher to find a price where traders will sell. And at some point, the bears give up. You can see each one of their attempts becomes weaker and weaker and weaker. Fewer and fewer bears are willing to sell, and bulls are becoming stronger. Although you cannot tell the bulls are becoming stronger yet, they're stopping the bears. The reason why the bear legs are getting weaker is a combination of 2 things. The bears are not selling as aggressively, and the bulls are buying more aggressively. Traders will start buying reversals up above this bull bar, above this doji, maybe above this bull bar, and then above this bull bar or above this pullback bar, betting that we'll try to probe up maybe to the top of the range. Maybe we'll have a bull swing. Bull breakout, 4 good bull bars, 5 bars up, and then we have a double bottom bull flag. Push down, push down. Traders will buy above the high of that bear bar or above the high of this bull bar, and you can see we have another breakout. It's a breakout of a triangle, and this is a pause or a pullback from that breakout, and then the bulls got a second leg up and it went up for several more legs as well. Anytime the market is going sideways, there are many different ways to label what's going on, but it doesn't matter how you label it, everyone's going to trade it the same. Everyone understands the process. Everyone understands the bears repeatedly are trying to get the downside breakout and failing, and therefore the market probably has to go higher to find a price where traders will be willing to sell. Strong bear breakout, strong reversal up. The market's probably neutral, big down, big up, big confusion, so probably sideways. This is a decent looking bull leg. First leg up, we got a sideways pullback. If you want, you can call it a triangle, or you can call it a higher low major trend reversal here, or a double bottom higher low major trend reversal. Some bulls will buy above here for a higher low major trend reversal. Bear trend, strong bull breakout, 2 legs down to a higher low, micro double bottom, down, and then up. A reasonable higher low major trend reversal. Other bulls will buy this as a double bottom higher low major trend reversal. Other bulls will buy this as a pullback from the breakout above the double bottom higher low major trend reversal. Double bottom higher low, not a very strong breakout, but 2 legs down to a slightly higher low, another reversal up. You can also say that we have a bear reversal and then another triangle, and we got a bull breakout of that triangle. First leg up in a bull trend here, and then a triangle. And then you could say this is a second leg up, a pullback, and a third leg up. Or you could call this entire thing a second leg up. No clear sign of a top yet, but possibly a second leg trap in that we're at the top of a trading range. This is climactic. It could be a measuring gap leading to a big trend up. It could be a climactic end of this bull trend. Don't know yet. But in any case, the bulls got a good reversal up after a triangle. We have a bull trend. We have a reversal down, third reversal down. We have a trading range with 3 reversals. You can call it a triangle. We have converging lines. We tried to get a bear breakout and we reversed up. We have a bull trend and a pullback. A high one buy, but it's big up, big down, confusion, probably more sideways. We're trying to reverse up again. Now a double bottom bull flag or high 2, high 1, high 2. Yet the reversal up could not go very far. And now we're getting a third reversal up. I still call it a pullback. There are fewer than 20 bars, and therefore the odds are the trend before it is still in control. This is still a bull flag and a bull trend. Once you start to get 20 or 30 bars, I start using the term trading range. this is a small triangle, less than 20 bars, the odds are the bull trend will resume, that we'll get a bull breakout. And therefore, it's not breakout mode, it's a bull flag. Traders will buy the breakout of the triangle, and then here they'll buy closes. It's a buy the close rally right here. Bulls, disappointed by this, they use this bar to get out break even if they bought that high close. Big up, big down, big confusion, probably sideways, and it's a triangle. 3 reversals down, 1, 2, and 3, and here we got a bear breakout. Whenever a triangle forms 20 or more bars into a bull trend, chances are it's the final bull flag. You might get a strong breakout, but the market's probably going to come back to the apex of the triangle before too long. We got a very strong bull breakout, a climax. We have 7 or 8 bull bars, each one closing at or above the high of the prior bar, and the bodies are getting bigger here, here, here. So we're accelerating up, but after a triangle and late in a bull trend. That increases the chances that this entire breakout will be an exhaustion gap late in a bull trend. And you can see we went sideways here. So this is a probable final flag, a triangle late in a bull trend, usually the final flag before the market enters a trading range or has a reversal. And you're looking for, at a minimum, a test of the apex of the final flag, the triangle. Traders will sell the reversal down. So we have a triangle top after a triangle bull flag. We try to get the bull breakout, 50-50 chance the breakout fails, and then we got a reversal down. Minimum goal typically is a test of the apex of the triangle, which we have here. Bear trend, bull breakout, probably not enough bars for a major reversal, and therefore it's probably a minor reversal, which usually means more sideways. Where are the consecutive big bull trend bars? We have bull bars, but bad follow through. Not enough buying pressure. Lots of dojis. It looks more neutral than bullish. And here, higher low, but 5 or 6 bars down, and the rally itself is not all that strong. This looks like a minor reversal, and chances are we'll go sideways. Different ways to draw a triangle. Reversal down, reversal down, reversal down. Or first reversal down here, down, down. 3 reversals up, 1, 2, and 3. Different ways to draw it, doesn't matter. It's a trading range, and the lines are converging. And once it gets 20 bars or more, it becomes a breakout mode situation. 50-50 chance you'll get trend resumption down, 50-50 chance you'll get trend reversal up. Is it a bear flag or a breakout mode setup? To me, I think we don't have enough buying pressure. I think it's more likely still always in short, and I think it's more likely we'll get a bear breakout. Traders are looking to sell below bars, betting on the bear breakout. We tried to reverse up again, but this was simply a pullback from this bear breakout of this triangle, or a pullback below this prior bear low. And you can see it tested one of the lows in the triangle. And then twice it tested, 3 times it tested, it resumed down. 3 pushes up, 1 pullback, 2 pullback, 3, or 2 and then 3. A possible wedge bear flag. Traders will sell the breakout below that bar, or the pullback from this small breakout. They'll sell below that bar and get short there. If you want, you can call this a triangle after the bear breakout, or you can call it a wedge bear flag, looking for a second leg down after this breakout. I began by talking about a triangle. I use a loose definition, a trading range, horizontal channel, where the lines are usually convergent, but not always. Some are expanding. I'll talk about that later. I'm looking for 3 reversals in a trading range. As soon as I see 3, I think of it as a triangle. If the lines are converging, I call it a triangle. If the tight trading range is still mostly horizontal, I'll call it a tight trading range. If it's a triangle and it's sloped slightly up or sloped slightly down, I'll call it a wedge. And finally, I talked about triangles as flags, continuation patterns within trends, or as reversal setups. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 2 videos on triangles. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 2 videos on triangles. Sometimes triangles expand, the legs get bigger instead of smaller, expanding triangles. And sometimes the patterns do not look quite right. The worse they look, the less reliable they are. A triangle is a trading range that has 3 reversals. Most triangles have converging lines, but sometimes the legs get bigger. Some traders would call it a megaphone pattern because it looks like a megaphone. Again, as soon as you see 5 reversals, it's a triangle. Reversal up, starting to reverse up, reversal down, reversal down. So 3 reversals in one direction, total of at least 5 reversals. It looks like a megaphone. It's an expanding triangle. It's a trading range, therefore it's a channel. It has 2 lines, one below, one above. And here the lines are expanding, and therefore it's an expanding triangle. An expanding triangle, if the pattern is big enough, contains 15, 20, 30 bars, it's always also a major trend reversal. Here it's a lower low major trend reversal. You can call it a double bottom, but it's slightly lower low. Again, if it's a trading range that's not tight, has at least 3 legs in one direction, 1, 2, 3, and the pattern is not small, if it has 10 or more bars, 15, 20 bars, the expanding triangle is also a major trend reversal. Lower low, major trend reversal. Bear trend, strong bull breakout, and then lower low, major trend reversal. Whenever you have an expanding triangle, either the second leg breaks strongly above a bear trend line, or the third leg breaks strongly above a bear trend line. And therefore, you got to be thinking about a possible major reversal. We have a test of the low, and we have a successful reversal. You can call this a lower low major trend reversal as well. Bear trend, bull breakout, test down to a lower low, maybe a wedge, 1, 2, 3. It's a reasonable buy. However, we failed on the breakout above this high, collapsed strongly, and got a new low. 2 legs down, 1, pull back, 2, a bull inside bar. It's a reasonable buy, taking a chance that it is a lower low major trend reversal. In this particular case, it's also an expanding triangle. Traders will look to buy the reversal up. You can call it either a lower low major trend reversal or an expanding triangle bottom. Every expanding triangle bottom is a lower low major trend reversal. Whenever you have an expanding triangle reversal and then the market gets to the opposite side, it usually tries to form a bigger expanding triangle. We have an expanding triangle bottom. We broke above the top of the triangle, tried to reverse down a second time. This is an expanding triangle top after an expanding triangle bottom. We have a trading range lasting more than 20 bars, lasted about 100 bars. It's in breakout mode. 50-50 chance there'll be a successful bull breakout. 50-50 chance there'll be a successful bear breakout. It's a fairly tight range. All trading ranges have both reasonable buy and sell setups within them. They also have many ways to draw the patterns. Reversal up, reversal up, reversal up, reversal up, and we have a slightly higher high. You can see an expanding triangle here. 1, 2, 3, 4, 5. 2 attempts up, 1, 2. This is a reasonable buy. Anytime you have an expanding triangle bottom and the market breaks above the top, you have to be thinking that it'll become an expanding triangle top. The patterns can grow. Sometimes you'll get 7 or 8 legs instead of just 5. Eventually, the expanding triangle pattern ends and it becomes something else, a trading range or a bull trend or a bear trend. Whenever the market's in a trading range, here the range is pretty tight. There are always multiple ways to draw patterns. Most of the reversals are minor. For example, is this rally strong enough so that when we get a test of the low, you'll get a major reversal? Probably not. It's not clear at all. Usually when you have a tight trading range, it's more important than any pattern that you see within it. And most likely the market will continue sideways. Eventually it will break out, but all of the breakout attempts have an 80% chance of failing. We're trying to get a bull breakout and then we try to get a bear breakout. And the tight trading range is going on, just adding more and more bars as it normally does. higher low, major trend reversal. A very strong reversal up. We have an attempt at a higher low here, again here, again here, again here, again here. Many attempts, but most reversal patterns fail within tight trading ranges. But remember my 80% rule. When the market's sideways, 80% chance breakout attempts and reversal attempts will fail, and the market will continue sideways. Obviously, every trading range eventually breaks out at some point, but looking at any one reversal attempt or any one breakout attempt, 80% chance it's going to fail. Expanding triangle, different ways to draw it. We have 5 pushes here. We tried to get the bear breakout. Instead, it became an expanding triangle bull flag. And we got another bull breakout and then another reversal. Is this a big enough pattern for a major trend reversal? This is probably not. It could be major, but it's probably minor. This is probably big enough. We have a pretty strong bull breakout and a very strong reversal. This has a better chance of being a major reversal. Leg 4 only had about 10 bars, mostly in a tight trading range. The bars are small. Therefore, this is probably a minor reversal. You can argue it's a bull trend. You don't see the bars to the left. You see some rally here. This is probably going to be a minor reversal, and the trading range will continue. On the other hand, this could be a big enough pattern for a major reversal there. Bears will sell the reversal down. Here we have a pullback, a double top, lower high. Traders will sell below that bar as well, taking a chance that we get the breakout. If you want a higher probability trade, you wait until there is a strong breakout. Here we have consecutive bear bars, big bear bars closing on its low. This is the bulls giving up. Traders agree that the price is too high. The market has to go down to find buyers. Higher probability sell, selling here compared to here. Different computers see different things and they label it differently. Some computers are looking for double tops. They see a double top. They see another double top here and here. Maybe they call this a double top, a double bottom bull flag, another double bottom bull flag. It doesn't matter how you label it. It's still a very tight range at this point, breakout mode. The computers will trade it the same, no matter how they label it. Traders are looking to sell reversals down and buy reversals up. Strong breakout below a trading range, which is also an expanding triangle top that had a pretty good reversal down. Strong bull breakout. This looks like a possible final breakout attempt on the part of the bulls, and it reversed down strongly. Some computers will say double top here and here, neckline of the double top, and we broke strongly below the neckline. And they'll start looking to sell. Here, a small double top bear flag. Push up, and then a bear bar. Sometimes the market repeats a pattern several times on several different time frames, so you get smaller versions of the pattern within larger versions of the pattern. When that happens, I call it a nested pattern. It increases the chances that the pattern will work as you expect it to work. Here we have an expanding triangle top, and it's within an even bigger expanding triangle top. So it's a nested expanding triangle top. It has a slightly higher probability of success. It's also nested into a larger expanding triangle top. So a small expanding triangle, a medium expanding triangle top, and a very big expanding triangle top. That increases the chances that this reversal down will be profitable for the bears. Expanding triangle top often evolves into an expanding triangle bull flag, and most expanding triangle bottoms usually evolve into expanding triangle bear flags. We have an expanding triangle bottom or a bull flag. We don't know what came to the left. If it was in a bear trend, this is an expanding triangle bottom. If there was a bull trend over here, this is an expanding triangle bull flag. You buy the reversal up in either case. And now we have another reversal down. Very tight channel. You can take that short, higher probability to sell here. 3 pushes up, 1, 2, 3. It's a double top, a second entry short. Some traders will take the first reversal down. Others will wait to sell the second reversal down. expanding triangle bottom or bull flag, and now we have an expanding triangle top. Another reversal up, a larger expanding triangle bottom. Now we have an expanding triangle with 7 legs. That's less common than 5 legs. Sometimes you get a pattern with 9 legs, which is even less common. Eventually the market stops creating expanding triangle reversals and it moves on to create some other pattern, as it did here. The expanding triangle pattern ended. Another expanding triangle, micro double bottom, down, up, spike and channel, spike, pullback, parabolic channel. Traders will buy above that bull bar. Many different ways to label a pattern. Some traders will say the expanding triangle began here with this reversal up. Other computers will say it began with this reversal down. It could be the 6th leg in the triangle, or it could be the 7th leg in the triangle. Doesn't matter. You trade it the same. We have an expansion pattern and a reversal with a good signal bar and a micro double bottom. Traders will buy the reversal up. It's important to pay attention to what the market's doing. It's continuing to reverse after every new high and every new low, and therefore you should look to buy a reversal up from a new low. You have to be ready to trade. When it gets above a prior high, look for sells. When it gets below a prior low, look to buy. Because that's what the market has been doing. Every breakout has been failing and reversing. We can't see what the market was doing over here to the left, but if it was in a bear trend and then we got this pattern, this would be an expanding triangle bottom, which is always a lower low major trend reversal. If the pattern was a bull trend, then this is an expanding triangle bull flag. In either case, traders are going to buy a reversal up, especially above a bull bar, especially when it's a second reversal up. We reversed up here, pulled back again, and now we have a bull bar for a high 2 buy. High 1 above this bear bar, high 2 above this bull bar. Traders will buy the reversal up. Stop just below. The minimum objective, the top of the triangle, or some other resistance level, which we do not yet have. You can always look for measured moves, a very strong first leg up, a little bit of a pullback below that breakout point, but still a possible negative gap that could lead to a measured move, which it did. Bulls take profits there, or they'll take profits on the reversal down, and bears will look to sell. Top of an expanding triangle pattern, bears will sell either the first reversal down, or they'll be concerned by the number of good bull bars here. Some bears will sell the second reversal down instead. It's a double top and a wedge, 3 pushes up, 1 bear bar, 2 doji bar, and then 3 or 4. Other traders will wait for the strong reversal down and then sell the pullback. Here we have an II with a bear bar, so they'll sell below that low, betting that this is going to be a successful double top. Double top, neckline, measured move down, maybe down to a new low, and a bigger expanding triangle. If you take the short here or here, stop just above the top of the pattern. Minimum objective, at least initially, a new low in the pattern, or maybe some kind of a measured move. We have a double top neckline, possible measured move down. We have a very strong breakout, maybe measured move down. Traders will look to take profits at those targets or on the reversal up, and bulls will buy on the reversal up. Finally, I want to talk about patterns that don't look quite right. The better a pattern looks, the more likely it'll behave the way you expect it to behave. If it looks bad, it's probably not going to behave the way you expect it to behave. The better a pattern looks, the more likely it'll work the way you expect it to work. Is this an expanding triangle here or here? I don't know. The spacing is bad. Only a few bars between points 1 and 3, and then a lot of bars between 3 and 5. When that happens, most computers ignore that pattern and look for something else, anything else. Leg 2 only has 2 bars, and then leg 4 has 50 bars. It's more of a tight training range than an expanding triangle, and therefore this is not a very good looking leg 5, and neither is this. They're more likely the start of bear flags in a bear trend than a reversal pattern. In other words, a minor reversal creating a bear flag is more likely than an expanding triangle, a major reversal. Computers ignore bad-looking patterns. They'll always look at it as something else rather than an expanding triangle. Bad-looking patterns, therefore, are low probability. They are as bad as having no pattern at all. So do not trade patterns that look bad. Again, we have a symmetry issue here. The spacing between points 1 and 3 is small compared to the space between 3 and 5. You cannot have tiny legs at the start of the pattern and then very big leg, a lot of bars in the final leg. It's useless. No one's going to be trading it, and if the computers and traders are not trading it as an expanding triangle top, you will not get a reversal. The reversal will be minor and become a bull flag. We have a very strong breakout. Possibly the computers will see this bear channel as a bull flag, and this is the breakout of the flag. It's more likely going to be a measuring gap leading to a measured move up than an exhaustion gap leading to a reversal down. Possible wedge bull flag, 3 pushes down, 1, 2, 3. Strong bull breakout, a slightly higher low. You can call it a big high 2, 2 legs down, 1, pullback, 2. You can call it a wedge bull flag. In any case, it's probably a pullback from this breakout. It's a slightly higher low. Traders will assume there'll be at least a small second leg up. Whenever you get a strong breakout, the market cycle starts over. You look for a pullback, and then a channel, and then a trading range. I began by talking about triangles where the legs get bigger and the lines diverge, an expanding triangle. If the pattern is big enough late in a trend, it can be a major trend reversal as well. It's really important to pay attention to how patterns look. If a pattern does not look good to you, it's not going to look good to the computers. And if they are not trading the pattern, there's not going to be enough money going into the pattern, and therefore the pattern will be useless. It will not do what you think it should do. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 2 videos on triangles.